I want you to imagine for a second a new technology that's exploding onto the scene. It's promising to revolutionize every industry imaginable. Companies with great ambitions are popping up everywhere, and they're promising to invest insane amounts of capital to build out the future. The hype is unreal. This is the future. It's gonna change everything. The media can't stop talking about it. It's mentioned in every earnings call. But then the cracks start showing. Overhyped promises don't seem to be turning a profit. Competition floods in, and then suddenly the market drops.
What the heck is going on down here? I don't know.
All of a sudden here, we started hearing screaming.
There's more to the story, but without knowing it, could you tell me, are we talking about the dot-com bubble or today? If you're yelling AI at your screen right now, you're probably not alone. But this was actually the dot-com bubble of the late 90s, where internet was the shiny new thing and everyone was betting the farm on it. Companies were raising billions only to crash and burn when reality hit. Trillions were wiped out and dreams were destroyed. Here's where it gets interesting. Change internet for AI, and that exact story could be unfolding in front of us in 2025. Chatbots writing essays, robots flipping burgers, autonomous vehicles taking you everywhere. Valuations are in the trillions. Startups are sucking up cash like vacuums. Palantir has a market cap bigger than some countries. Yet with recent market shakeups, are we staring down the barrel of history repeating itself? Let's zoom in on the evidence. Has the AI bubble already started to deflate, or is this all just speculation and fear? We'll break down the similarities and differences between the dot-com and the AI bubbles, spotlight the killers like Palantir and others, and most importantly, we'll talk about how we can stack our chips to make sure we get rich whether the bubble pops or not. Right now, the S&P 500 is more concentrated than it's ever been in the stock market's history. In the dot-com era, the top 10 companies accounted for 25% of the whole market. Today, the top 10 account for over 40%, with NVIDIA, the king, sitting on top with a $4.5 trillion valuation. To put $4.5 trillion into perspective, that's larger than India's GDP, a country that has 1.5 billion people. This matters to your portfolio whether you like it or not, and that's because if you invest in the S&P 500 or other similar funds, they're betting heavy on AI, and your portfolio depends on this going smoothly. With the unfolding of the fourth industrial revolution, coupled with the government's backing due to national security concerns, the real question is, how long can this all go on for? Truth be told, I think that what's been put into motion cannot be undone. We are on a path that is going to change the world, and it's just not up for debate. As the internet did for information sharing, AI will do for automation and scientific discovery. We are not building the roads for data like we did in the 2000s. We're building our own replacement. As investors, we need to control our emotions and realize that we cannot just put our money into whatever company and become rich. The internet rollout was and is unstoppable, but that doesn't mean that individual stocks and companies didn't get crushed in the path. As we saw in the dot-com bubble, many companies went bankrupt and many investors did too. The real question we need to ask ourselves as investors is, how do we avoid this same fate? Let's take a look at some of the top players today, find out why they're special, and then break down some of the risks involved with them so we can avoid putting ourselves in a terrible situation like the dot-com bubble. Today, I see three main paths for AI. We have the picks and shovels, we have the real-world AI, and we have artificial general intelligence. For number one, we have the crown jewel of the market, NVIDIA. As the saying goes, when everyone's digging for gold, sell the shovels. That saying is great, but it doesn't justly represent NVIDIA, because what NVIDIA is selling can't easily be replaced, and they are the supplier of next generation chips. The competition for NVIDIA is coming, but these companies need to spend billions of dollars to compete, and there's no guarantee they're going to dethrone the king. Number two, just like the internet boom, people wanted to see that hype turn into real world profits, and there is no better company than Palantir when it comes to implementing AI to make a real difference in a company. Palantir's ontology is taking raw data from many different systems and turning them into real-world actions that yield real-world efficiencies. You don't have to take that from me. Here are some real-world businesses that swear by Palantir and are showing off their efficiency gains. For Palantir, the question isn't will they be profitable, It's how much profit will they make. Number 3, the name that kicked off the AI revolution, the for-profit, non-profit OpenAI. OpenAI's goal is to assemble the brightest minds, to build the biggest data centers, and to ultimately develop artificial general intelligence. With an incredible 700 million weekly active users, they are by far the most used AI, and they are set up to massively capitalize on those users. Everything sounds great, right? But let's take a look at where this could end up going. With AI accounting for the majority of all GDP growth right now and a slowing labor market, we could be in for a real problem. The issue is, if the job market slows, spending will go down. If spending goes down, investors are going to lose confidence. And when investors lose confidence, there's less money out there for AI companies that aren't turning a profit. For companies like OpenAI, if the capital investments slow or stop coming in, they're not making a profit and they're not going to be able to fund these data centers. So they're either going to have to delay or stop them. If they start delaying and stopping data centers, the market is going to panic. And this is where we get into a real issue with that circular financing we all see. If this starts to unravel without government funding, it could take the entire market down with it. If the whole market starts sliding, even companies that execute flawlessly and are making great profits are going to get crushed due to their sky-high valuations. Before we all panic, let's take a step back from that doomsday mindset and take a look at where we are. Earnings season is about wrapped up, and over 80% of companies beat their target earnings. That's more companies beating their earnings than the 5 to 10 year average. Some companies are reporting layoffs, but their reasons are for efficiency increases after the COVID boom and not necessarily for a market downturn. The AI demand is still extremely strong, with the Mag 7 projected to spend over $460 billion on CapEx. There's no signs of slowing down yet. We also have other tailwinds like the new tax code, which should incentivize new construction, the Fed lowering rates, and a potential word of the government shutdown ending. There's no doubt there is risk investing in this AI cycle, but there is also risk in not investing in it, as we don't know what part of the cycle we're in. The last thing we want to do is miss out because we are too fearful, but we also don't want to overplay our hand because we are too excited. So, how can we invest to guarantee a successful outcome for ourselves in the long term? I am not a financial advisor, but here are some of the things that I think you should focus on. Number 1, invest like Graham Stephan by dollar cost averaging into a simple, low-cost index fund. This strategy is foolproof because as long as you're consistently investing and don't panic sell out, time in the market will do its thing for you. Number 2, identify and invest a small portion of your portfolio into the companies that have the greatest chance of being the winners in the long term. These are going to be companies with great moats, solid financials, and absolute great execution. These companies should have a clear path to continue their success in the future. Stay away from speculative plays, as those are the ones that get slaughtered in the downturns. Number 3, always have cash ready. You never know when the next opportunity is going to present itself, and if you're in a position to capitalize on that, that's when you're going to make the most money you'll ever make. The real money is made when you buy. If you're sitting on cash and the market crashes, you're going to be able to buy in heavy, and your future self is going to be thanking you. Technology is a relentless force for transition, and it's reshaping our world in ways that we could never imagine. Yet history has shown us human nature has a predictable flaw. Markets will surge with irrational exuberance, inflating bubbles that ultimately pop. The key is to turn volatility into your advantage. If you're mentally prepared, armed with patience, discipline, and committed to timeless investing principles that we outline, the next few years will propel your wealth to extraordinary heights. If you enjoyed this video and want to see more, please like and subscribe. As a new creator, someone who forgets to put on his lights during the recording, it would mean the world to me, and it will nudge the algorithm in the right direction. Thank you so much for watching, and I'll see you in the next one.